Topic explains how governments and central banks manage exchange rates, and the implications of exchange rate policies for economies and financial markets. Exchange rate management is important because currency values influence international trade competitiveness, inflation, capital flows, and economic growth. Governments may allow exchange rates to fluctuate freely according to market forces or intervene directly to stabilize or influence currency values. The chosen exchange rate regime reflects a country's economic objectives, financial structure, and policy priorities. Investors closely monitor exchange rate management policies because currency movements significantly affect international investment returns, corporate profitability, sovereign risk, and global capital allocation decisions. The topic distinguishes between fixed, floating, and managed exchange rate systems. Under a fixed exchange rate regime, a country's currency is pegged to another currency or a basket of currencies at a predetermined value. Central banks must intervene actively by buying or selling foreign currency reserves to maintain the target exchange rate. Floating exchange rate systems allow currency values to be determined primarily by market supply and demand forces, with minimal government intervention. Managed or dirty floating systems combine elements of both approaches, permitting market fluctuations while allowing periodic intervention to reduce excessive volatility or achieve economic objectives. Each regime involves trade-offs between stability, monetary policy flexibility, and external competitiveness. Fixed exchange rate systems can provide stability and predictability for international trade and investment. By reducing exchange rate volatility, fixed systems may encourage foreign investment and support lower inflation expectations. However, maintaining a fixed exchange rate often requires significant foreign exchange reserves and may limit a central bank's ability to conduct independent monetary policy. If market participants believe a currency peg is unsustainable, speculative attacks can force governments to devalue the currency or abandon the fixed system entirely. Currency crises may emerge when foreign reserves become insufficient to defend the exchange rate. Analysts therefore evaluate reserve adequacy, external debt levels, and economic fundamentals when assessing fixed exchange rate sustainability. Floating exchange rate systems offer greater monetary policy independence because central banks are not required to defend a specific currency value. Exchange rates adjust automatically according to economic conditions, helping economies absorb external shocks more efficiently. For example, a weakening currency may improve export competitiveness during economic slowdowns by making domestic goods cheaper for foreign buyers. However, floating rates can also create significant volatility, increasing uncertainty for businesses and investors engaged in international trade or investment. Rapid currency fluctuations may contribute to inflation, financial instability, or capital flow volatility. As a result, many governments intervene occasionally even within broadly floating systems to maintain orderly market conditions. Central banks use several tools to manage exchange rates and influence currency values. Direct intervention involves buying or selling domestic and foreign currencies in the FX market to influence supply and demand conditions. Monetary policy adjustments, particularly changes in interest rates, also affect exchange rates by influencing capital flows and investor demand for financial assets denominated in a currency. Capital controls may restrict the movement of funds across borders to reduce exchange rate pressure or financial instability. Governments may additionally use foreign reserve accumulation, communication strategies, or coordination with other central banks to stabilize currency markets. These tools influence inflation, trade balances, and investor confidence across economies. Overall, topic highlights the complexity of exchange rate management and its importance within macroeconomic policy and investment analysis. Exchange rate regimes influence monetary policy effectiveness, inflation control, trade competitiveness, and financial stability. Fixed systems offer stability but reduce policy flexibility, while floating systems allow adjustment but may create volatility. Central banks must balance domestic economic objectives with external financial pressures when managing currency values. For CFA candidates, understanding exchange rate management is essential because currency policies directly affect international investments, capital flows, corporate earnings, sovereign credit conditions, and global financial market behavior. Effective analysis of exchange rate systems therefore supports stronger macroeconomic forecasting and portfolio management decisions.